Preparing to live stream the meeting live on Facebook. You know what time it is? It's time to sing. We should really get. I should get somebody to write this music down. But Money Monday is starting soon. 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 Here we go. Share now. Public. Boom. Share it to your profile. Fantastic. All right. Oh. One more thing I wanted to do.
That wire.
Bring the entire setup here down. All right. Fantastic. Cool. You're hearing different sounds of me tripping. All right. Hi, everyone. Thank you so much for joining us here today. I am, as always, your friend in finance, Henry. We're joined here today with Chris Tanner.
Hey guys, hi Henry.
We got a very exciting episode of Money Monday today for everybody, based off of real events that are happening in the world today, but also finance basics. So you're going to learn a fun new phrase, and you're also going to learn how to deal with it in today's fantastic modern world. Let me just make sure my sound is working here. All right, great, perfect. Let me erase this here because we are starting. Before we do start, a couple quick housekeeping things. First of all, this is for our clients. We do have our book club starting this week. I've talked to a few of you, and and the people that I've talked to have actually said that the email we sent out for the book club, it ended up getting in their junk mail folder. So if you haven't gotten an email about the book club, check in your junk mail. We're starting this week. It's going to be on Wednesday. Pretty excited. Even if you're not a client, we highly recommend this book. It's called Why Smart People Do Stupid Things with Money, written by a very great financial advisor called Burt Whitehead. He actually taught our boss, and he's just phenomenal. The way it's a whole different way of looking at finances than I had ever experienced before. I don't know about you, Chris, but it really kind of opened my mind to, there's things that anybody out there can do, some really easy steps. So if you're a client, check your email, your junk mail for the book club email, and come join us. Once again, this Wednesday, we're going to be meeting every other week. If you're not a client, still highly recommend the book, Why Smart People Do Stupid Things with Money. Afterwards, I should have done this beforehand. Afterwards, I'm going to go in, and in the details, I will write down the title of the book, as well as provide a link to buy the book too, because it's just a really good book. Again, the guy's not associated with us in any way, aside from he was Bob's mentor, so just a very smart person. Also, in line with that, if you haven't done this yet, sign up for our newsletter. It comes out once a month. You don't want to miss any of the fun things that we're doing, whether it's webinars, whether it's book clubs, things like that. We also always put out good content on our blog, and including finance basics, things like how to open an IRA, what is compounding, what is inflation. Like today, this is going to be an article that's going to be up and coming. So, with that being said, I kind of left kind of the bag right there. What we're going to be talking about today is inflation. You might have heard this in the news a lot recently. The media started to pick this up. We've been talking about this for a while now, but the media, I finally started seeing it pop up in news stories. I think the previous 2 months, last month, the inflation was, they said it was 5%, and then the month before was like 4.2, something like that. So there's high inflation coming in. That's leaving a lot of people wondering, what is inflation, first of all? So we're here to answer the question. And fortunately for us, Chris has a major in economics. So he is. I'm always talking about how smart he is, but this is especially a place where he can provide a lot of value for all of us. So I'm going to put the question up here. And Chris, how would you define inflation?
Thank you, Henry, for that intro. And I would define it simply as just a sustained increase in the price level of the goods and services that people want to buy.
Ooh, I like that. Sustained increase in price level. I'm going to just say price for ease of writing.
Great.
Of goods people want to buy. So, they do, they do have these reports coming out. They're saying like, last month inflation was at 5%. How is that calculated?
Yeah, so I'll real quick, that stat for the month of May being at 5% for those listening. When we say 5% in May, 4.2 in April, that's not, the percentage just in that month. That's the rate for that month if it lasted a whole year. So we're definitely seeing an increase, but we haven't seen a 9% increase in all prices from the start of April. So just for those that, that are hearing those numbers for the first time, that's the annualized rate, or just if the rate from May were to be extended over the course of the year, then we're seeing 5%, which is higher than it's been any month really in the past decade plus. But then to your question, Henry, how is it measured? So let's look at the definition first. The kind of central authority that comes up with the number for this, they first decide what are the goods and the services that people want to buy, and they create what's called the Consumer Price Index. And so they look at kind of a basket of goods that the average American household might own and spend money on. So that'll include housing costs in some form. That'll include food, restaurants, recreation, all these things. And then the CPI, Consumer Price Index, is an index which tracks what is the price of all the things in this basket, and adds them all together. And over time, if there's an increase that's sustained, it continues in the price of those goods, then that's inflation.
Yeah, that's fantastic. And I was underlining, as you said, these different words, and that shows the robustness of that definition too. But yeah, so it sounds like this reporting body is looking at the specific prices that people are actually paying for things that they normally buy, and over time, as those prices go up, then that means that inflation is also going up as well.
Yes, that's exactly right.
Fantastic. And so Consumer Price Index, that's actually the report that I was talking about. So fantastic. So Consumer Price Index, how, and I guess this is a good segue. How do you think what are some ways that people might experience this right now with inflation being so high?
Yeah, great question. So a personal example from my life, my wife and I, we just built a wooden walkway in our backyard. It's kind of a deck, but it's at ground level. We don't really know what to call it, but we had to buy lumber to build it. And lumber is very expensive right now. We paid a couple $100 just for a few lengths of 2x6 boards, because we ended up using actually pallet wood for most of it. We tried to go, sustainable with it, but for the foundation, we needed good treated lumber. And the price of lumber is now, it has kept going up, but it's very high currently. And so we've seen a sustained increase in a good that people, businesses, construction companies use. And so I'd call that inflation in the price of lumber.
Yeah, and so as lumber's going up, like you said, other businesses are also affected. They have to raise their prices, otherwise they're not going to make any money and they'll go out of business. And I was telling you about this earlier. I just read an article about how shipping costs have become extremely expensive. I think in the article I read, there was an example of one person had paid like twice the amount that they thought that they expected they had to pay because as the economy is opening back up, people have money they didn't spend last year, so they're starting to order things and get things shipped to them. But what ended up happening is that there's so many people doing that there's just not enough. There's not enough boats even to take things from Europe to America, or from Asia to America, or vice versa from America to any of those places. And because there's more demand for those few receptacles to be taking these things back and forth, then those prices are going up. In the article that I read too, the one person was shipping some stuff, expected to be able to get things shipped to him by train once they got to Los Angeles, because he was in Minnesota. He expected things to go by train, which is pretty quick and efficient, but there were no spots available on the train, so he ended up having to pay for a truck to drive it all the way from San Diego, California, all the way to Minnesota, which is a pretty long way, and that really drove up the price. And he was making like some sort of a specialty good. I'm not sure exactly what it was, but he said that he had to turn around and raise his prices to account for the surprise shipping costs that he had suddenly gotten. So shipping costs here, so that's something that might be affecting things. I know today is actually Amazon Prime Day, so as people are on Prime, you might notice that prices might be higher than they were a year ago, and that might be one of the reasons. Something I didn't think of earlier, one of the ways that it's a sneakier way for inflation to happen is by companies changing the sizing of their packaging over time. So I'm trying to remember. This is a while ago that I saw this report, but it was something like if you went back in the day, if you went and got a family size pack of something, that was the big pack. Now, if you go to the store, instead of getting the family size crackers or whatever, if you really want the big pack, you got to get the party size. And it's been just slowly happening over time that the family size pack has been shrinking and shrinking and shrinking, but staying the same price. And that's one of the ways that they're able to account for rising shipping costs and things like that. So that's one of the ways that different companies account for inflation. We're actually paying the same amount of money for less, which is basically it's basically the same thing of that sustained increase in prices for things and goods we buy.
Yeah. And I like, Henry, I like how you said with the shipping example that a business owner might be forced to pass on, like raise their prices because of the shipping costs being higher. So that's one of the ways that inflation spreads through the economy, because you can, with the lumber example, if it's more expensive for a construction company to build houses, you can expect the prices of houses to go up too. And so inflation in lumber prices spreads into other areas. Shipping, companies that rely on shipping, that cost goes up for them. And then to still make ends meet, to make a profit, they raise their prices.
Yeah. One thing that so we're talking about how like the demand for shipping is making those prices go up, which is making inflation go up. What are some other reasons why inflation might go up or down? This is a little bit of a curveball for you. This is something people are probably wondering, but I just realized that it might be a question people might have.
Yeah, no, great question. And I mean, the foundation of economics is supply and demand. And so either when demand goes up, so people want more of the thing and there isn't necessarily more of it available, so demand goes up and supply stays constant, that's gonna cause inflation. It'll increase the price. And so with the lumber example, maybe the same amount of trees are being chopped down, but more people want to build houses and build decks in their backyard, like me and my wife. Or there's the same number of shipping containers, same number of ships, but more people are ordering stuff online and not going to stores in person. So that's one way. And then the other way can be on the supply side. If demand stays level, but supply goes down. So let's just say there's a storm that wipes out, all of some kind of plant, say all the corn in the state of Iowa. Then we all still want our corn and our chips and, everything. But if the supply has been wiped out, there isn't as much corn to go around, then the price is going to go up. And that'll be another driver of inflation.
Yeah, that's really good. And I like the supply and demand idea too, because that's a really good way to picture it. Like, what do I want and how much of it is there? And one of the important things to note too is that when inflation happens, high inflation, that means the dollar is worth less and less. So another way using that same supply and demand, going from the point of view of the actual currency, if there is a lot of supply of the dollar, but demand stays the same, then that dollar is going to end up being worth less and less, which is going to cause inflation as well. Or conversely, if the amount of dollars stays the same, but people just don't want it anymore for whatever reason, that will also cause inflation. That was a really good tangent that we took. I'm really glad that came up.
Yeah.
There was, Chris, there was one other example of prices of inflation happening right now, and I can't remember that we had identified it earlier, and I can't remember what it was. Do you remember?
It was wages, and you had just we've seen wage growth picking up in the last few months. That's getting some coverage, and just the relationship that might have with inflation.
Right. Yeah, because this is one of those things where a lot of people I've heard a lot of people say, and I actually used to have this belief too, where if wages going up is a trigger for inflation. Wages go up, then we're gonna have inflation. But there was a video that I saw with a really famous economist, Milton Friedman, who actually pointed out that usually what ended up happening, the reason why people believe that is because when inflation happened, at that point, labor unions would have to renegotiate their contracts asking for higher wages. So inflation would happen and then wages would go up. And the wages would go up afterwards. But because people always saw those things happen at the same time, people ended up creating this false correlation between the two, which it is somewhat correlated, but Milton's point was that it's not as strongly correlated as everybody thinks. And if everybody went in negotiating hard for their wages constantly, then we wouldn't have that false correlation that we currently have. Correlation, I'm saying that's a statistical word. Relationship, this false relationship.
Yeah.
When one goes up, the other one automatically goes up, and it's not quite that. That's not quite that tried and true as it might seem on the surface, if that makes sense.
Yeah, I think that's a good point to make.
Yeah, and that was really surprising to me too, because Milton Friedman's also a very free market, and so I was very surprised he had anything nice to say about labor unions, just because he was incredibly free market, and basically said let the markets kind of govern themselves. So the fact that even he was saying there's no scientific correlation between these two things, I was like, oh wow, that's got to be true, and I hadn't even thought of that. So that's pretty fantastic. Cool. So so those are some things that might happen when inflation happens. So some people might be wondering out there, Chris, is inflation a good thing or a bad thing? We've just talked about prices going up. Does that automatically mean that inflation is the worst thing in the world?
That's a great question to ask, because like a lot of things in life, it's actually something that's good in moderation. And so if you have too much inflation, that is bad. If your store has to go through and change price tags on every item every single day, or if your local restaurant has to update its menus every single day, like that's bad. However, the opposite of inflation is deflation. And we don't have to go too deep into deflation, except that it means that prices are going down. And so the basket of goods that most people buy is getting cheaper and cheaper. And that sounds like a good thing at first glance, but it's actually very dangerous for the economy. And the main reason for that is when deflation is taking place any given day, it's a good idea to wait another day to buy anything, because you know it'll be even cheaper tomorrow. So I'm just gonna sit on my $1 today and spend it tomorrow, because I'll be able to get $1.10 worth of corn or candy or whatever, or lumber. So, which creates a very dangerous spiral in the economy, because then money isn't flowing, the value keeps going down, deflation just spirals. So deflation sounds good, not a good thing for the economy. It's so bad, in fact, that where you want to be is a safe distance from inflation. So for that reason, the Federal Reserve, our central bank, and this is the case in the US and other countries around the world as well, aims for inflation to be low, positive, but low. So they don't want crazy positive inflation, but they definitely don't want deflation. So a target for the past 10 years or more has been 2% inflation. So giving you enough of a buffer so you're not at risk of slipping into deflation with just, any small blip, but also keeping it at bay so you don't have really rapid growth.
Yeah, and I think one way for people to kind of picture what deflation looks like is actually what's going on in crypto right now, in cryptocurrencies. Some of the cryptocurrencies actually have deflation built into them. So over time, they're actually, because at a certain point they stop creating more of the cryptocurrency, each unit becomes worth more and more and more. But what ends up happening is that if the value of the thing is really going to be going up, people don't want to spend it. I mean, right now, and that's going to actually make it harder for a cryptocurrency to become mainstream, which is the goal of what cryptocurrency wants to do right now. An example of that is, for instance, Bitcoin. I know that Tesla said that they were going to start taking Bitcoin again, which for the second time. But the thing is, if you're looking at it from a financial point of view, if you purchase a Tesla for a single Bitcoin, because they're about worth about $35,000 now, then the car that you're getting in return is going to just be worth less and less and less and less as time goes by. Meanwhile, that Bitcoin you gave up is going to be worth more and more and more and more. So it was really, from Elon Musk's standpoint, it's really kind of a no-brainer, because he's creating one depreciating asset for one that's theoretically going to grow and grow and grow over time. But that might make people, when people realize that might make them want to spend less of that cryptocurrency, which means it's going to not be used as much, which means as a currency, if nobody's using a currency, then currency is only as valuable as the value people give it. So if nobody's spending it, then it might as well. There's an Aesop's fable about that, about how guy puts gold in a hole in his backyard. A thief comes along and takes it, and the guy only ever stared at it. He never used it. And so he's upset, he's crying and all this stuff. Neighbor sees him, asks what happened. Guy explains, I used to stare at this gold every day and it just got stolen. And the guy said, well, were you ever going to spend it? And he said, no, I would never spend it. And the neighbor says, well, then just put a rock in there and stare at that, because that's about as much value as you're getting out of it right now. That's the danger of deflation, is that it just becomes a very expensive rock that's in your pocket, which is that's a whole other discussion, which we've already had about some of the risks involved with cryptocurrency. So inflation, a small amount of inflation, about 2%, is actually a good thing. That's the goal. So right now we're heading into a higher inflationary period. Like we said, we're looking at about 5% annualized inflation last month. Chris, what are some of the things that people could do to kind of protect themselves from inflation? Now that we have high inflation, what are some things that people should do?
So I'll start with the maybe more unusual one, if not controversial, but having a mortgage in times of inflation is actually very good. You want to be a debtor, and we'll explain what we mean by this when inflation is going up. Because let's just use an example. Say I owe Henry $100 and he wants me to pay him back $1, every day for the next 100 some days to pay off that loan. If inflation is really high, then each next day, the dollar I pay Henry is worth less. So it would benefit me if he extended that from 100 days to 200 days or to 100 years. Then each next dollar I pay him will be worth less because of the inflation that's taken place. And when you own a home and have a mortgage on it, especially a 30-year fixed rate mortgage that's about as long as most standard mortgages go, you're paying off that debt with cheaper and cheaper dollars. So whereas the bank who lent you the money for the house is getting dollars that are worth less and less, but you have a fixed rate 30-year mortgage, and that's making you benefit from the fact that inflation's happening.
Yeah, and I just put this little caveat in here: have low interest debt too, because this isn't permission to go and spend max out credit cards or anything like that. Mortgages, like Chris mentioned, they do have very low interest rates. They're like right around maybe a little bit over 3% now for 30-year fixed rate mortgages. Low interest car loans. If you have a low interest car loan, that would be another example of a good debt to have. I know somebody who got like a 2.8% interest rate on a car loan, and just pretty awesome. Low interest student loans, which is again over the long haul, paying it off over the span of a lot of years. You're paying it off with those cheaper and cheaper dollars. But again, so being a debtor is good, but again, don't go out there and just start maxing out credit cards, because the 20% interest rate on credit cards is going to very easily keep pace with unless we enter catastrophic inflation, hyperinflation, or something like that. Credit cards are still we don't recommend using those for purchases, things like that.
For incurring, we don't
Yes.
recommend incurring debt that will actually be accruing that high interest. So thank you for making that point, Henry, because there is a fine line, and when you have a loan, how do you determine if this is a good debt or bad debt? Is this a low enough interest rate? At what point is the interest rate too high? And that's something that a financial professional can help you decide. So if you have questions, Henry or myself,
I was just gonna say, like,
happy to speak into that.
Yeah. Yeah, because we've definitely walked people through, okay, let's look at the interest rate, let's look at what your monthly payments are, how long is that going to be for? And we walk people through that process of judging whether or not is it a good debt or bad debt. Because as you can see, in certain situations, there is such a thing as good debt, especially in high inflation. But you want to make sure you're identifying it correctly. That's where we can come in. So give us a text, give us a call, show up at our houses randomly, that kind of thing. So fantastic, cool. So some other ways that people some other ways that people can protect themselves from inflation. I actually had 2 conversations with people about this because people didn't know this kind of thing existed. It's a type of bond, a type of government bond called a TIPS. There we go. This marker's running out of ink. TIPS, which stands for Treasury Inflation Protected Securities. Now, a normal bond, I went over this in Money Monday, I think one of like the very first ones. I think I might have explained it with Beanie Babies back then. A normal bond, you get like say like $100 bond, and that $100 bond is going to pay out. It's going to pay out interest. Let's say every year. Bond rates are so low right now. So
let's say $2. That's kind of optimistic, but $2 per year.
Let's say you get $2 for a $100 bond. So so that's still below inflation, because again, inflation is going at 5%, and that's what you would get. As you can see, you're not quite getting enough of a return to really even keep pace with inflation. That's a regular bond. Over here, let's talk about tips. Because let's say at the beginning of the year, you get that $100 bond. It still pays you out a small, low interest. Chris, I don't actually know this off the top of my head. Do tips usually pay lower interest than regular bonds? I would assume so.
They do. That's a trade-off for the inflation protection. So something less than $2, let's say $1 for this example, would be the starting point.
Cool. Awesome. I had a hunch, but I was like, I don't actually know this for certain before I say it out loud. So you get $1 in interest, dollar signs right there. You get $1 in interest. You'd think that you'd end up being worse off with the tips bond, but if inflation is at, I think we said 5%, at the end of the year, the principal amount, this amount right here, actually gets adjusted for inflation. So it becomes $105 plus the $1 you made. At the end of the year, you end up coming out with $106, whereas over here, you end up staying steady at $102. So you can see that in times of high inflation, bonds like these tips bonds are very well able to protect you from that high inflation, from losing what's called purchasing power. So you're still going to be able to, that bond is still going to be able to buy the same amount of stuff at the end as when you bought it at the beginning. Now these bonds are bought in large denominations, like $1 million bonds, $1 million tips bonds. I think we were talking about before. So how can this be available to regular people like you? Well, luckily there are, and you've heard me use this word before, there are index funds for that. There are passively managed mutual funds, index funds for tips. So you can actually go out there in your brokerage and start incorporating some of these in your portfolio, so you can stay protected and keep your purchasing power over the long haul, while at the same time these are guaranteed by the government. So not only do you get protection from inflation, but you come with the as risk-free as you can get in the world of investing, because they're guaranteed by the United States government. Unlike buying a stock in which the company might go bankrupt and suddenly your stock is worth nothing. The U.S. government, like Bob mentioned today, the U.S. government has the power to tax and to print more money to make sure that its debts are paid. Which I think it's always funny thinking about. But yeah, the U.S. government does have the power to tax, and it's probably a good thing that Apple can't tax us, because or Google, because suddenly we'd all be in real big trouble.
That's true.
Yeah. Chris, did I miss anything when talking about tips bonds?
Well, you stated this, and I'll just restate or add the detail that you may in general know that bonds are a safer investment than stocks. You're more likely to get your money back / not lose your money with a bond than a stock. But the flip side of that is that a stock is going to pay you a higher return for that risk that you take. But within bonds, Henry brought great attention to the fact that the government bonds are your safest bet, because corporate bonds, so bonds which are issued by individual companies like Apple, you can buy bonds from Apple, you can buy bonds from Amazon, those are still tied to the fates of the company. So if the company goes out of business, you're still you may lose your money owning a bond. And so just distinguishing within the world of bonds, they're mostly safer than stocks. However, it's specifically government bonds, or usually it has treasury in the title. That's what is really the safest.
Yeah, I was trying to anticipate what you were going to say next and gesture along with what you were going to say, and I don't think I did a very good job, but yeah, I absolutely agree. So treasury, and again, in TIPS, that's what the T stands for. Treasury inflation protected securities. You know what, Chris, I was just thinking this, if you're watching this and you're just joining us for the first time, you might be wondering, all right, so great, so there's TIPS out there, there's stocks, how do I know how much I should be putting into each of those, because they're going to be in separate funds. We actually have on our website, on the Plan&Act website, you can sign up for a free bronze account, and you can actually get a free assessment that will end up giving you a starter portfolio allocation. So whether you want to be, depending on what stage in life you are, you might want to put 50% in bonds and 50% in stocks, or you might need to be a little bit more conservative and have 75% in bonds, 25% in stocks, something like that. It's really hard to know. There's especially for somebody who's just starting out. So if you're just starting out and you're curious about what do I do next, I don't know. I don't even know what funds to purchase. What do I do? Go to our website, sign up for a free bronze account. You're not going to get charged anything. You're not even going to be asked for credit card information or anything like that. It's going to be completely free. You get the starter portfolio, and you already off the bat, you're going to be getting a lot of information about where are you in life financially, and how can you start mapping out your path towards financial freedom. I think it's a super important thing to know, and we give it away for free. So if that sounds like where you're at in life, come join us on Plan&Act, and you don't even have to talk to either one of us if you don't want to. We'd love to talk to you, but you can just go on our website and you can take care of that yourself. Once again, I think that we're innovating a lot of stuff with technology, and I think that having that free assessment out there is I wish that I'd had it when I started out investing years ago, when you show up on the website, on the brokerage website, and they go, do you want an aggressive, do you want a moderate, or do you want a conservative portfolio? And I would go, I guess aggressive. How are we supposed to know? I think I always just picked moderate because it's in the middle, I thought. But the truth is there's a lot of factors that can come into play about what's actually going to be appropriate for you. So Plan&Act, go sign up for a free bronze account, take a free financial assessment. That's going to give you a lot of answers right there. Chris, I'm not sure if I see, did somebody comment something on the Facebook page on our video?
Actually not, I'm not sure I see where the comments would be from my view.
It would actually be, have to expand it. That's Brian talking about his, Brian said, ugh, I have 29% on my Amex. I think that was back when we were talking about credit cards, and how the high credit card interest is they're going to very easily keep pace with inflation and all that. But that's, Brian, that's okay. It's I'm honestly, the fact that you're aware of it is the first step towards dealing with it. So that's really fantastic. There's a lot of people that when they first come to us, they don't, and I was guilty of this too. Before I took our financial assessment myself, our next steps plan, I didn't know what the actual interest rate was on my credit card. And then that forced me to go in, look up a statement, and go, oh wow, that's a 20% interest rate. So there's really no hope for catching up there. So if that sounds like, if you're watching this and you're going, I know I have balance on there, but I really don't know how much the interest rate is, I highly recommend, just for your knowledge, go into the statement, go into your credit card statement, look it up. Knowledge is power, and there's a reason why they make it difficult to find. They make it really difficult to find because they don't want you thinking about that. They want you to continue paying that, so they make more and more of a profit. So go check it out. Credit card statements, go check out Plan&Act.com and sign up for a bronze account. There's a lot of really good stuff that we're offering. Yeah, fantastic. Before we head out, Chris, do you have any final thoughts?
No, I think you hit everything. You're an excellent host. So what can I say? We did it.
Thanks for joining. Thanks for joining us again. And once again, if you are a client and you haven't seen the email for the book club, go check your junk mail, because some people, it's ending up there. And even if you're not a client, if you want to join us for the book club, come sign up for a silver account, and we'll include you in the book club, because I think it's gonna. I'm quick aside. I am so impressed by the community that we're building here. The people who reach out to me, let me know that they're watching these every week. Sometimes, even if they can't make it on the day, they're reaching out later and they're telling me, "Hey, I caught this, and thank you so much for doing this." I want to thank you all so much for doing this, for watching this. We're big believers that financial literacy, financial education is so important for helping us all together move forward in this economy. And you being here watching this, learning, that's the first step. So thank you so much for joining us. It's an honor and a privilege to be able to do this for you all. So thank you again, and I hope you guys have a wonderful night.
Yeah. Bye, everyone.
Now I'm going to do my awkward walk off because I have to go and turn off my the sharing on my computer. So just pretend this didn't happen.